So as it's 12 o'clock on the dot, I think we'll get started. So thanks everyone for coming along to Simmonds Stewart's first webinar. So it is a bit of a step into the technology unknown for us with doing this for the first time. I did a webcast or webinar with the Kiwi landing pad that Sian Simpson set up, but she's an absolute pro. So hopefully we don't have any technical glitches for everyone. But we've had 80 people or so registered for this webinar, and so far it looks like we've got about 50 odd that are live, which I think just demonstrates how much interest there is in ESOPs if people are giving up an hour of their lunchtime to listen to a couple of lawyers talk about a topic. So thanks everyone for tuning in, and hope you find it useful. So just a few housekeepings first. So if you have some questions, jump in and ask them on the in the chat box there, and either Fiona or I will try and keep a note of them, and we'll aim to deal with questions at the end depending on how much time we've got and how many questions we can answer. So in actual fact, it may be best to store up your questions till towards the end, and then we can jump into it then. And we're going to try and keep this to an hour, but we can run over a bit longer if there are lots of questions, and people can obviously jump off the call at that point if they're losing interest. Hopefully people won't jump off beforehand. Being lawyers, we've got quite thin skin, so if we see the people watching are down to only one or two, by the end we'll be quite sad. We've got a few lawyers jumping on the webinar as well, and this is worth a CPD or continual professional development hour. Lawyers have to do, I think, 12 hours of CPD a year to keep their registration. If you would like a certificate for your attendance, just drop me an email, which you can find on our website, and I'll just send you out a letter confirming your attendance. We've also, this is going to be the first in a series of webinars, we hope at least, if there's sufficient interest ongoing. We've got another one scheduled in 2 weeks' time that Julie Fowler and I are giving, and that's on the topic of term sheets for equity investments. And if you want to register for that, it's now featured on the homepage of our website, so you can jump on there and register. We'll probably send a follow-up email if we can work out how to do it in Crowdcast, inviting you from Crowdcast to the next webinar as well, but that's on the assumption we can work out how to do that. So our two presenters today are, first technical challenge, changing the pages on my PowerPoint. Here we go. So our speakers today are me, Andrew Simmonds. I'm a partner at Simmonds Stewart. Some of you may know I tweet under the hashtag EvilLawyerNZ. So you're welcome to follow me there for the occasional sarcastic opinion about things going on in the New Zealand economy and tech ecosystem. So I started Simmonds Stewart in 2006 with Victoria Stewart, and it was just two of us to start with. We were involved in the tech ecosystem then, and at that stage I just finished at a prior firm acting for the Trade Me shareholders on the sale of that company. So, I was got off to a flying start with Simmonds Stewart there. What we found in those early days of tech companies was that actually very few of them actually had any sort of formal employee share scheme set up or had any employee participation at all in the equity of startups. And I think there's a few reasons for that. It was quite hard to do it in the first place under New Zealand securities laws. They made it quite difficult to offer options to staff. And the penalties for breaching New Zealand securities laws then were pretty draconian. And also, I think there was a general, unlike Silicon Valley, where employee participation has been kind of a bedrock of the whole economic model, in New Zealand, what we've been a lot more used to is entrepreneurs, the self-made people who make their money from building their company alone without the help of outside investors or with employees sort of participating in equity. And kind of investors, we're used to that model as well. So often you found an investor might want an ESOP, but the founders didn't, or the founders wanted an ESOP, but the investors didn't. So when you add on the complexity of securities law limitations, we might have found maybe 10% of the companies that we dealt with back in 2006-07 had ESOPs or serious plans to put ESOPs in place. So that all changed in 2013 with the introduction of the Financial Markets Conduct Act, which includes a pretty broad-ranging exemption from securities laws for employee share schemes and makes it administratively very easy to offer equity participation to employees. I have to be nice about the exemption for employee share schemes because MB engaged Simmonds, Stewart and me to advise on it, and I was right. I wrote some of the design of it, so I have to say that's pretty good. And I think that's coincided with the increasing sophistication of the New Zealand tech scene. That by then there was really a large sort of wellspring of demand from tech companies to implement employee share schemes. Investors expected it as well. So I think the introduction of that act was a bit of a what's the word? There's a bit of a breaking of the dam as well. We released a template ESOP scheme documents on our website in 2014, and that's been tremendously popular. I mean, it's been downloaded thousands and thousands of times. I don't think there's probably been thousands and thousands of ESOPs set up using it, but I suspect that it's been used hundreds and hundreds of times by New Zealand tech companies to implement their own ESOPs, and other lawyers who can use it to help their companies implement ESOPs as well. So the next big change that came along was in 2017 when the IRD published its intention to... okay, hang on. Somebody has... Okay, some people can hear me and the odd person can't. I'm afraid I'm not going to be able to solve that technical problem if some people can't hear, because it suggests the problems at their end rather than our end. Yeah, so one thing is, yes, you have to be on Chrome or Firefox. Or another one. Okay, I will carry on. So in 2017, the IRD published a bunch of discussion papers about revamping the law in relation to employee share schemes or the tax law. And what they were concerned about is that the tax treatment of option schemes was fine from the IRD's perspective. It resulted in tax being paid on gains, but an industry had developed in the creation of share purchase schemes that had all of the economic features of options, but also were treated as capital gains and tax wasn't paid. So that resulted in a bunch of consultation and some new tax laws in 2018, or 1 April 2018, that we're going to talk about today. So that's the point that I'll hand on, or at least describe Fiona, and Fiona can then jump in and crack on with her part of the talk, which is describing the new tax laws. So Fiona's been with Simmonds Stewart for about 8 years, 8 happy years, I think she likes to say. She's done heaps of ESOP wrangling in that time, setting up ESOPs using our templates, wrangling other people's ESOPs, dealing with exercise of options by employees and changing option schemes and that sort of thing. She's also been heavily involved with the development of our templates in this area. So she's an absolute mine of knowledge in the area. So I'll hand over to Fiona at this point to talk about the tax regime, and over to you, Fiona, and I will, in the background, change the slide. Oh, was I going to talk about this slide, Fiona? You're on mute, I think, Fiona. There you go. You're unmuted. So whilst Finn's just fixing that, so I skipped over this slide pretty briefly, but so up until 2018, there were two types of share schemes that were being used in New Zealand. Share option schemes, where an employee's issued an option to purchase shares at some point in the future at a price that's agreed today. And these were simple and cheap to implement, and tax was payable on the gains made only if the employee exercised the option to purchase the shares. So it was very efficient from a cash point of view for employees, in that they didn't have to buy the shares until they were confident they were going to be worth something, but it did mean that they would have to pay tax on the gains. The other type of share scheme that became increasingly prevalent really over the last 3, 4, 5 years was more complicated schemes designed by the accounting or the tax advisors at accounting firms and 1 or 2 law firms that were designed to put shares in the hands of employees that they could hold on capital account, but for all of the economic features of those schemes to look like options. So the company would loan the employee the money to buy the shares, and the employee would only have to pay that loan back if the shares were in the money. And that there's a number of mechanisms people use to do that, but essentially people got the shares on capital account but didn't have any of the risk that's associated with owning shares. So I can hear Fiona's back. So if you want to have a go again, Fiona, from there.
So we're good to go?
Yes, we're good to go. Yeah, I can hear you. So
Right,
the new tax rules.
New tax rules were introduced on the 29th of March this year. The idea from the IRD being to ensure that the taxation of employer share schemes is modernised, simple, efficient and fair. High-minded values indeed. So fundamentally, the effect of the changes coming out of the new tax rules are that tax-free capital gains. I wonder if we've lost Andrew there. I'll crack on just in case. Tax-free capital gains are no longer available by way of a share scheme unless the share scheme is structured in a way that the employee participant in that scheme is essentially on the same footing as any other investor. The other fundamental change being that share schemes in the traditional form are essentially taxed as options now, rendering the time and resources required to set up those complicated share scheme arrangements that were so popular essentially uneconomical and not really worth it now. So what do we mean when we talk about the new share scheme effect? So the complicated structures that previously characterised share scheme arrangements, whereby people were trying to shorten the amount of time between the date of issue of the shares at which market value was determined, at the price paid for by the employee for the shares was determined, and the date at which the tax liability crystallised and you had to determine the market value of those shares was shortened to the maximum extent possible, thereby limiting the amount of opportunity for the value to increase and essentially the tax liability to increase. So the complicated structures that previously characterised those share scheme arrangements, including, for example, limited recourse loans, partly paid share arrangements, they're now essentially taxed in the same way as options. So when I talk about limited recourse loans, they would have been loans along the lines that primarily the amount repayable by the employee for those loans was limited to the value of the shares at the time the employee was repaying them. So tax under the new rules, tax is going to be calculated at the point that the employee basically has the full opportunity of upside, but also the quid pro quo of that is exposed to the full risk of downside attached to the shares. So essentially, at the point where no safety net is available to the employee, the new tax rules don't apply to arrangements that require employees to pay market value, for example, and they don't apply to arrangements that require the employee to suffer any downside. So when we talk about essentially being taxed in the same way as option schemes are, an option scheme traditionally is taxed at the point where options are exercised. So the two dates that you were talking about are the date of issue of the options and the date that they are exercised. And that could be several years between the two dates. So the idea being is that any upside in value between the date of issue and the date of exercise becomes the taxable advantage at the exercise point. So at the date of exercise, you calculate the market value of the shares that have been purchased when the options are exercised, and the difference between what the employee was required to pay to purchase those shares on exercise of the options. The difference obviously becoming the tax line, the benefit upon which the tax liability is calculated. And now the old school share scheme arrangements were intended to essentially have the issue date of the shares and the tax date of the shares be broadly the same date, thereby sort of limiting the amount of potential upside in value and limiting the tax liability, limiting the benefit and then limiting the tax liability. So share schemes, unless they expose the employee to the full risk and reward, are now basically, under the new tax rules, going to be taxed along the same lines as option schemes. So option schemes, same old, essentially, same as it's ever been. Tax is paid not at the issue date of the options, but at the date that they're exercised. And the tax liability is calculated, again, by reference to the strike price versus the market value at the date of the exercise.
Cool, thanks, Fiona. So just explaining slightly more about what the employee bearing the risk, I suppose, or being exposed to the full upside and downside of the shares means. Essentially, if the company or a company sells shares to an employee at full market value and there's no arrangement to underwrite that from the company, then there's no tax to pay at that point because the shares have been purchased for market value, however you determine that, and that's always challenging in the tech company space. And the employee can hold them on capital account, but it's not so attractive, and it doesn't really meet the needs of most tech companies to do it that way because employees don't have that sort of money sitting around and they don't actually want to put it at risk by investing in a tech company. And I'd have to say I wouldn't encourage your average employee to do that, because if they're investing their hard-earned savings into just one company, you know, these companies have a 1 in 10 chance of success, or in my experience, actually a 1 in 10 chance of actually returning anything to you. You know, employees purchasing shares for full value is, it's not a, you know, it's generally not a great thing for them to be doing. It's a bit different if you're talking about a well-heeled chief executive or CFO who've got a decent amount of dough and can afford to put some of that money at risk. And that they probably have a preference for buying shares that they can have on capital account and not pay tax on the capital gain. But that's not really an incentive scheme in the way that is talked about in Silicon Valley. So it is worth mentioning something else that's changed. And for all of you that are issuing options going forward, you're going to have to deal with these reporting obligations, and you'll have to work with your tax advisors, which will probably be an accounting firm, to manage these things. So the ID has had a problem historically that it has no visibility into the choices people were making about how they treated the taxation of employee share schemes and of options. So people would, it was really up, they exercised a share option and made a gain. It was up to them, or a notional gain anyway, it was up to them to decide what the amount of that gain was and to include that in their annual tax return and possibly pay provisional tax on the way through on that gain as well. But unless a person actually put that, unless a person exercising a share option actually provided that information to the IRD, the IRD had no way, or actually voluntarily did that, the IRD had no way of knowing that a possibly taxable event had occurred. So people could exercise share options and not make any declaration about tax being payable, and they might convince themselves, I suppose, that there wasn't actually any gain at that time, and the IRD would be none the wiser. And so this is a fundamental part of the whole rewrite that the IRD has been trying to address. So it's now, and I think I've got this right, but if anyone knows better and there's anyone from the IRD on the call that wants to correct me on this stuff as we're talking, that'd be fine. So you're now required to report the issue of employee or shares or options under an employee share scheme in the month that they're issued to an employee. And this then allows the IRD to actually keep track of what potentially taxable instruments are out there. Then when an employee exercises an option, it's necessary for the company to report to the IRD in that month or in that monthly schedule the amount of the benefit that the employee has actually received. And that requires the company to make a determination of the valuation of the company at that time, because that's the only way you can work out the amount of the benefit the person's received, the difference between the exercise price on the shares and the market value of the shares at that time. That's actually a bit of a tricky one, because if it's in the connection with a liquidity event, the company being sold or listed, well, then you do obviously have a market value for those shares. But if somebody exercises an option, just nothing's changing in the company, it's just business as usual, it's actually quite hard often with these tech companies to work out what they're worth. The IRD's put that onus on the company. However, and it's released guidance on its website about how you calculate that. And the IRD is quite taken with the idea that if you've had a capital raising or a particular venture capital investment recently, that you should link the valuation of those of the benefit to that capital raise. I'm not convinced that that's a particularly fair way to value a minority shareholding in a technology company where a small shareholding doesn't have any right of liquidity, but that's the IRD's point of view. It's actually quite different in Australia, where it's not really linked, or at least there can be a big delta between the venture capital valuation and the valuation of a exercised option. That's the same in the States as well. But in New Zealand, the IRD didn't like that because it doesn't get any sort of later catch up under a capital gains tax. In any event, the employee exercising the option isn't bound by whatever determination the company has of its value that it sends to the IRD. But I guess when it happens, if the employee then files a different value, a lower value, or doesn't file a value at all, it doesn't actually volunteer to pay the tax, then the IRD would presumably be contacting the employee to explain. So Casey Plunkett has very kindly just clarified that I got something wrong. So Casey is the person from the IRD who is the architect of the new rules from 1 April. So it's very kind of him to jump on the call and to give us the benefit of his knowledge. So Casey is saying that it's not necessary to report the issue of options to IRD, it's only on exercise. So that is at least one less obligation that I thought was there, but wasn't. The IRD, I spent quite a bit of time talking with the IRD and Casey and his team about the implications of this scheme for the startup community. The IRD was very keen to learn about the startup scene, and a lot of the concerns that it had were actually being driven by bigger companies and listed companies that had some pretty sophisticated schemes that were intended to deliver some more aggressive tax outcomes for the companies and their employees. But it was good to have the opportunity to talk about this with the IRD from the little company's perspective, and particularly to try and keep complexity down, because complexity is death really for technology companies. Anyways, that's reporting. A few sort of random points to note. So founder vesting arrangements are not going to be caught by the rules treating share purchase schemes with vesting as being taxable. So when I say founder shares, I mean shares issued to founders on incorporation of a company. And it doesn't matter that the vesting arrangements are put in place at some later date. If you got your shares on incorporation of the company and 6 months later, or when you get investment, you decide to put a vesting arrangement in place, that's something that's given up voluntarily. It's not related to employment, and that won't be taxable. There will be a bunch of companies that have got these more complicated tax-driven share purchase schemes in place that relate to the old world, where you could get the economic benefit of an option, but the tax effect of a share purchase. They're grandfathered if they're implemented before 12 May 2016, or if the vesting dies off by 1 April 2020, you're not going to be penalised under the new rules. But that's looking back retrospectively to schemes that are already in place, and going forward it's not possible anymore. One benefit of the IRD's new rules is that the benefit that an employee has to pay tax on gives rise to a corresponding deduction on the part of the company, which seems a bit weird initially, but when you think that an option is dilutive to the economic base of the company or the shareholders in the company, it is a cost to the company. It is treated as a cost under IFRS, so it makes sense for the benefit to be deductible, even if just for a lawyer that's a bit mind-bending because it's tax payable by the employee, not by the company. But anyway, that's a handy thing to know. So just some quick conclusions. So tax is going to be payable on employee share gains regardless of the type of scheme, unless full market value is used. Therefore, you might as well use the simplest method of incentivizing your employees in these employee incentive schemes, which is options. The documentation for options is really simple, it's flexible, and because it's simple, it's cheap to implement. And from a tech company point of view, spending money on complicated schemes that don't offer any extra value, be it tax or economic or commercial value, it's just stupid, really. It's a waste of money. Do things as cheaply as you can. Spend your money on getting more customers, getting more revenue, getting investors, that sort of thing. So, I mean, from our perspective, we think you can set up a share scheme in such a simple way that you can make your own, which takes us to the next part of our talk, which is making your own ESOP document. So originally, and we still have them on our website, we had some templates you could download. We've gone a step further and created a tool on our website where it'll guide you through setting up an ESOP, and then it'll email you the documents afterwards that you can then go and use in anger. And if you've got a bit of understanding of, if you understand the parameters of the scheme you want to set up, then it's very easy to use that tool to go and set up your own scheme. So I'm going to do a bit of a walkthrough of this, and Fiona's going to hopefully interject if I get anything heinously wrong. But I'll just explain a couple of things first that I guess set the scene. So in the States or in Silicon Valley, employee share schemes tend to start off as 15% of the total equity of the company at the time of a Series A investment. And those shares are actually issued and held as treasury stock. So if an employee gets a share option allocation, they're actually getting an option to purchase shares that are already in existence. So when you see a cap table in a Silicon Valley startup, the options or the stock allocated to share options actually exists. You could see it on the company's share register, and that's very clear cut. In New Zealand, that's actually doesn't really work that way, because under our Companies Act, it's not that easy to issue that sort of treasury stock. And instead, what happens is employees or a company issues an option to purchase a share in the future, and that share is only issued if and when the employee exercises the option. This can sometimes be a bit difficult for people to get their head around, but it bears repeating that a New Zealand employee share scheme, the underlying shares are not actually issued unless and until the employee exercises an option. It has the same economic effect as a US scheme, it just looks a little different. What that means is it's actually necessary when you're undertaking a capital raising to provide information. I'm just clicking through to try and find my example here. It's actually necessary to show a bit more information or create a bit of a fiction in your capitalisation table. So I'm just going to show you quickly. Fiona, can you see the capitalisation table here that I'm showing?
Yes.
Yeah. So this is how it works in a New Zealand context. This is what it turns into. This is Simart is the Simmonds Stewart investment company, and I'd like to think it was worth $5 million. They're investments in tech companies, but sadly it probably isn't. But we have a little fiction here. So you can create one of these cap tables with a template from the Simmonds Stewart website, and you see here you've got two shareholders, Andrew and Victoria, having some shares. You have ESOP that's described as unallocated. So there's no shares shown as actually being owned, but the options are accounted for, and you can see that Andrew and Victoria's shareholdings are diluted by those these notional options that the board has agreed to issue at some point in the future, or it might have actually issued, although it says in this case these are unallocated, but it doesn't matter whether they're allocated or not. They're just being accounted for in the capitalisation table. And then if we have a new investor investing $1 million and getting 2,000 shares, it turns out like this. The investor still wants to see the ESOP in the cap table as if all of those options had been fully issued and actually exercised. So that then dilutes Andrew and Victoria's shareholding further. And in this case, the ESOP post-investment ends up being 8.6% of the company. So it achieves the same thing, but it is necessary to have this little mathematical fiction in your cap table. Is anyone massively confused about that before I just jump on to showing you making a scheme? No, nobody's asking a further question. So I think to do this, I need to share a different screen. Oh, Mark McCarthy says all good, so I'm going to, thanks Mark. Now I'm going to share another screen. No, not that one. Just bear with me for a second while I get this working right. So Fiona, can you now see the Simmonds Stewart homepage?
Yep.
Yeah, cool. So on our website, we've got resources and doc makers, and quite a few of you will be familiar with all of our templates. Our doc makers are something that we're just continuing to fill out over time. And so what we want is our employee share scheme doc maker. You'll see it's perhaps a bit hard to see on the screen because it's turning out on white on my screen, but I'm already logged in to our website. So I've got an account and I'm set up under, I've got a My Documents, which records all of the documents I've made to date, and I can go back and find them and re-edit them and that sort of thing. So the first time you come and use one of these document makers, you need to create an account so that you can go back and access your stuff in the future. It's not that we're going to spam you or that sort of thing. So I've just clicked on Make Document Maker. The way these work is we've broken them up into sections that kind of are logical in how you think about the components of a document. So company details, employee details, option details, vesting details, and resolution and certificate if you want it. We've got a nice video narrated by Victoria here if you want some more explanation over how the whole account system works. Now, for most of our doc makers, you can when you go save or submit, when you finish the form, you can just download the document. But because there's multiple documents to do with this ESOP, you actually have to have them emailed to you. So in this case, I'm going to have them emailed to myself. And so we just have to quickly fill in the name of the company, and it's the 1st of August, and the street address. That's my home address, but anyway, that'll do. And I'm the company representative signing it. I'm a director. And there we go. So that was, this is, although, that's pretty obvious and simple information, just having this on a web form just makes completing the template way faster. That was one of the frustrations that I had using our old Word templates. It's still great for people to have access to those Word templates to use, but as a tool, I found them a bit frustrating. So we're going to issue Fiona some options to recognise her contribution to Simmonds Stewart. What's your middle name, Fiona? It's K, I know.
It's Katrina.
I should know that. And you don't live with me. You live somewhere in that clock. And you're an employee, very happy employee, hopefully getting some shares in our investment company. And we're going to give you 1,000 options to purchase shares. So this is where it starts to get into the more economic things that are more interesting. So obviously you have to decide how many options you're giving somebody, and you have to decide on your exercise price. Generally in New Zealand, the exercise price that is set by tech companies for options, it tends to equate to the board's view of the current valuation of the company. And the reason for that is the board or boards and founders and investors generally want employees to be incentivized to increase the value of the company from today. But there's no legal requirement or even tax implication for doing it that way. So the fair market value of shares in SimArt might be $1 per share, but there's nothing to stop me from issuing the shares at 1 cent per share, and Fiona has therefore got options that are immediately in the money. And I might do that for a bunch of reasons, but in Silicon Valley, that would not be an uncommon thing to happen. So if you issue shares, so if a company in Silicon Valley is worth $1 per share, you tend to find that the options would be issued at about 10 cents per share. And in part, that's to recognize the difference between ordinary stock, which is what is used in Silicon Valley companies, and preferred stock, which is what the VCs get. But actually, the economic rationale for it is just to make the employees potentially as rich as possible. And the thinking being that the more rich employees can become from the option scheme, the more likely they are to move heaven and earth to make the company really valuable, and therefore to make the founders and the investors rich. And, this is not just something that I've read in a book. I hear US founders and US VCs talk like that. They're genuine they genuinely, it's baked into the whole DNA there that making employees rich is the way to making founders and investors rich. And yeah, so there is a difference in practice in New Zealand, but there is occasionally options in New Zealand are issued at below current market value as a reward or to do a bit of a recut of the capitalization table if people's original options are out of the money, or if you're issuing options to founders to sort of top them up due to dilution from investment rounds, but that's unusual. So anyway, so going to put $1 there. And I don't know, I can't do the exact maths, but I'm going to make it up and say Fiona's getting 8% of the company. Now,
thank you.
Now the next thing you've got to think about is the option expiry date. In Silicon Valley, so this is the period during which you can exercise your option. If you don't exercise the option during the expiry period, then the option will lapse and it's gone away, and whatever economic benefit was tied up in the option is gone. From an economic point of view, the longer the term of any option, an option to buy something or an option to sell something, the longer the term, the more valuable the option is. In New Zealand, it was quite common for years for employee share options to be issued with a term of 5 years. And that was sort of seen as creating some incentive on employees to drive to a liquidity event within 5 years. But it kind of hasn't aligned with reality that the time taken to get to liquidity for New Zealand companies is a lot longer than that generally. And employers are coming to realise that. Also, it kind of forced often an artificial decision on employees about whether or not to exercise options at the 5-year anniversary in hope of a liquidity event within the next few years. But that then created tax liability on the part of the employees that they had to fund from their own cash flow pending a liquidity event. And that's quite painful, actually. I've done it myself. I've bought shares under an option arrangement for quite a large amount of money, 180 grand, and had a $100,000 tax bill to pay at the same time. And it made that quite expensive. Obviously, at that point, the shares I held on capital account because I had no immediate intention of selling them. But for me, I'm not a 20-year-old, I'm not a 25-year-old. I could afford to make that investment, but many people wouldn't be able to, or they'd have put them under difficult circumstances. And also it's very risky, of course, just to have one big lumpy investment like that. So where that's gotten to is we now recommend a minimum sort of exercise term of 7 years. And some people have 10 years. Occasionally we see people go with an indefinite term, although that would be unusual. But we think 7 years, which is consistent with Silicon Valley, 7 or 10 years is fairer to the employees and causes less sort of difficulties. The question about financial statements is just a compliance issue that arises under the FMCA. You don't have to have audited accounts, but if you do, that's what you have to provide to employees. So the next commercial thing to look at is vesting details. And so the idea with any employee incentive scheme is to get people to stay in the company for a minimum period and to kind of devote their life to the company and making it really valuable. And how that's operationalized is shares or share options are subject to vesting. You get them progressively over a period of time. You don't have the right to exercise them all on day one. So looking at Fiona's case, we don't want her leaving after 36 months. That'd be terrible. So we're going to give Fiona a 60-month sentence, which is 5 years, benefit. And so Fiona's, to get the full benefit of the shares that, to be able to exercise her option for all of the 1,000 shares we're allocating, or options we're allocating to her, she has to stay for 60 months. And Fiona's shares are going to vest from the date of this letter, but sometimes people go for an earlier vesting date to take account of the fact that often these have been people are putting their option schemes in place later than they should have. They've made promises to employees we're going to have one, and sometimes it's 12 or 18 or 24 months before the company gets around to it. It's not uncommon for people to be given credit for that time served, and this form gives you the option of doing that. Most commonly, options vest monthly. So in Fiona's case, 1/60th of her options will vest every month. You could say quarterly, which, a vesting date is a date on which somebody might decide to leave the company. If you think people behave rationally based on economic incentives. So if the period between, it's a bit like bonuses, you assume that people are going to leave the day after an annual bonus, not halfway through a bonus period. Now, it's also quite common to have what's called a vesting cliff. So you have to stay a minimum period before any shares vest at all. And it's quite common for the cliff to be 12 months. And this math should probably be automated, but generally what happens is at the end of your 12-month cliff, for example, you get catch up of all of the prior 12 months vesting. So in Fiona's case, she's got 60 months vesting total. So at the end of year one, she gets 20%, 12 months being 20% of her total vesting. So if Fiona left a day before the end of the first year, she would have no shares vested. If she left after 13 months, she would have 13/60ths of her shares vested, and she would be able to keep those and exercise the option to purchase those 13/60ths of her shares when she felt that was the right thing to do. Now, would you like a director's resolution and certificate as well? Most people will. And we can just quickly do that. So it fills in the details that it knows, and many of the directors have conflicts of interest. You'd obviously have a conflict of interest if you're issuing options to yourself, which directors do sometimes. And where have a conflict? That's just a good housekeeping thing in your resolutions to record directors' interests. I mean, you obviously, sometimes I'm just being a bit flippant with Victoria's conflict of interest, but sometimes they're just things that should be noted. Sometimes they are actually things that are really quite material conflicts that shareholders could get upset about. You're required to do it under the Companies Act, and it's just, we've tried to surface that to make it easy for people to do. So then we can just hit the submit button, and the documents are ready. They'll pop up an email. I don't have my email open on my computer just for confidentiality reasons, but rather than wait and get them by email, I can just go into my account and I can see, you can see I did a previous time. I called Fiona Karen McKinnon, but here is the correct version. So I can go into the account at any time and have a look at these documents. I can open the form again and change it. So if I wanted to now give some share options to Chris Wilson, I wouldn't necessarily have to go and I don't have to create a whole form again. I can just go and once I've got Fiona signed up, I can then go and just reuse this data for Chris without having to fill it all in again. I think there's a facility somewhere to do a duplicate form, but I don't think we've got a button for that at the moment. So what does it look like? I open the PDF, it's probably not going to show. The PDF isn't showing on the screen, Fiona?
No, not yet.
Okay.
No.
I'll have to just go in and just do a new share screen. Is the percentage based on the fully diluted ownership? I think that is what it is saying, and we'll go back, and when we see the form, you'll see. And Steve Whitaker asks, is it possible to get a recording of this? Yeah, we are recording these, I think, and I hope, and we're going to, they'll be available on the Simmonds Stewart website. So, you know, our aim with all our resources is to make them available for free on a website that just creates more stuff for the community. Somebody's given me a hint here. This is Ross. Just click the tab at the top of the screen to see the PDF. Oh, I can't think on the fly, Ross. Do you want to answer that question, or see if you can answer that question, Fiona, while I'm just getting the...
So Hayden asks, is it common for the consideration payable by the employee to be simply the performance of services to the company at market value versus payment of cash? And what is the tax implication in that situation? I wouldn't say that, but so my understanding of that question is it common rather than for a cash exercise price to be payable to exercise the options to purchase shares in the company? Is it common for that rather than a cash price to be the performance of services? I've not come across that in my experience so far. But I suppose
I can probably jump in there. I mean, so essentially it's a sweat equity arrangement. We do see that a bit. We find it a bit uncomfortable advising on sweat equity arrangements because sweat equity doesn't fit so squarely within the, certainly somebody putting all of their salary into the purchase of shares. It's not really an incentive scheme anymore. It's a buy-in scheme, or you're effectively investing your own money into the company, and that has the potential to fall outside the exemption, which I haven't really focused on for the purpose of this talk. I mean, some lawyers and quite a few founders who I've said that to think I'm being really namby-pamby there, and I think even the FMCA sort of brushes off that discussion, saying there's an employee share scheme exemption, so it should be fine. But from a tax perspective, I think there'll be the person is getting a benefit. They're getting shares. If the value of the shares is equal to the value of their services, and that's what the description is talking about, then tax is simply payable on the value of the services or the value of the shares in the normal way. And that, this is assuming that there isn't any vesting arrangement or other deferred condition that then means it ends up getting treated like a option. But both the FMCA and the IRD, I guess their rules don't work that well with sweat equity, and it's something that we always find it's a bit uncomfortable trying to work through all of that. So perhaps that's an area that there could be some further discussion about with the IRD in particular. So I'm conscious that we've got 5 minutes of the sort of formal part of the webinar left. So I just wanted to show you what a simple share option deed operationalizes into based on the form I just filled out. And Fiona, we can see the share option deed there?
Yep.
Yeah. So those of you that are familiar with Simmonds Stewart templates will recognize this. So the exercise price is $1. The expiry date is the 7th anniversary of the offer date. It could have been a fixed date if we said that. There's 1,000 options, and the shares vest in the Schedule 1, and the vesting period is 60 days, and there's a start date. So some of this is just, obvious legal boilerplate. The company will issue the options. The options vest progressively in accordance with Schedule 1. and the employee can exercise options that are vested at any time. So the flip side being you can't exercise an option that hasn't vested. And if the option isn't exercised prior to the expiry date, it just goes away. And there's a process that you have to follow to exercise your option by giving notice. Under our deeds and under any sort of, I guess, lawyer drafted option scheme, then there is a automatic adjustment of the number of options to take account of bonus issues or consolidations or subdivisions. So if the company does a subdivision, issues 1,000 shares for every one on issue, the owner would get 1,000, would have 1,000 times 1,000 options. Is that 100,000 options? I think that is my maths. Generally, in our, well, certainly in our templates, the shares that are issued are ordinary shares, and they rank pari passu or identically to all of the other ordinary shares in the company. They'll rank behind any investor preferred stock. But in New Zealand, the difference between preferred shares and ordinary shares is not as great as it can be overseas. And if this is really critical of what happens when the employee leaves, any options that haven't vested are cancelled automatically. So if Fiona left 13 months into her 5 years of happiness with us, all but 13/60ths of her shares would be automatically cancelled. Then this is a bit of a critical provision here, B. It says that all options that are vested at the leaving date may be exercised on or before the expiry date. So in our standard template now, employees get to keep their options right up to the vested options when they leave, right up to the expiry date. Unvested options are cancelled. In the States and in New Zealand, it has often been the case that employees are forced to exercise their options within 3 months of leaving a company. That creates some big heartburn for people because of the need to come up with the money to exercise the options, but more importantly, to come up with the money to pay the tax. And if you're exercising options at a very low price, you could have a very, very big tax bill. And the heartburn, that creates a lot of heartburn for people. So there is a bit of a move away from that forced exercise on leaving, and allowing people to take the benefit with them that they've worked for over the vesting period. Options of there's accelerated vesting if there's a liquidity event. So if our company Simmonds is sold in 18 months' time, all of Fiona's shares vest at that point. So then she gets a full 8% of the proceeds of sale of the company, less her exercise price. And that's just, sort of baked into virtually all option schemes that they operate that way. And, the rest is just a bit of legal boilerplate. So we've tried to keep it absolutely as simple as possible, including the vesting schedule. So 20% of Fiona's options vest 12 months after the start date, and then the remaining vest in equal amounts 13 months from the vesting date. If I was really clever at my programming, I would have said what the monthly vesting amount was, but that required some more JavaScript that I couldn't deal with at the time. I'll just show you what the I'll just show you what the actual offer letter looks like. So the deed is the formal legal document, but we also have an offer. The tool also produces an offer letter, and this refers to approximately 8% of the shares of the company. There was a question about diluted or fully diluted. I think the intention that percentage is stated as a fully diluted percentage, but I think thinking about it, Fiona, that's something we could perhaps clarify as that's what's intended. One of the reasons for sending a letter as well, apart from the fact that it's a nice way to do it, is that there is a requirement under the FMCA exemption to describe the share scheme, and that's what this summary is, but also to say some other things, about the constitution, drag-along rights, tag-along rights, requirement to sign up to shareholders agreement. You have to tell them to get independent advice, although virtually none will, and you have to tell them they've got a right to receive an annual report. Actually, it is an important point that is not covered in our slides, but it is teased out in the notes to our tool. That is, if you're going to implement an option scheme, you need to have a constitution in place that is appropriate for that. And in particular, you need a constitution in place that has a drag-along provision and that turns off a whole lot of the annoying minority protection provisions that require you to get unanimous consent from shareholders, because you don't want to have to chase around after a bunch of employees with tiny shareholdings, getting them to sign things or trying to convince them to sign things to enable you to do things like issue more shares or that sort of thing. The Simmonds Stewart Constitution, that there is also a document maker for, is set up that way so that sort of straight off the bat, it plays nicely with an option scheme and plays nicely with options created under this particular documentation. Some schemes have rules that one rules document that applies across all option grants, but that still requires a shorter deed and or option grant letter, and we've never really seen the benefit of having those rules in addition to just a simple deed and a letter. But it isn't to say it's wrong. We just try to use the least amount of paper in legal arrangements as we possibly can. So you'll see that we've taken up our hour. So that's probably all I'm going to say. Well, that is all I'm going to say from a formal perspective in the talk. I'm now going to, I need to share the screen again. Oh well. We'll just open it up to questions, really, for anyone who has any questions or has any feedback. I'm just going to read through the... So thank you for everyone that's attended. And if anyone, we won't be offended now if anyone drops off. And those that want to do stay for a few questions or questions and answers, you're welcome to do so. So Cameron Ford asks, can you touch on how tech startups are solving the valuation challenge? It's too early to say, Cameron. So at the moment, as I say, when options are issued, the board tends to choose an exercise price that is an approximation of the current market value of the company, or that's set in relation to the price of the last investment round. And that's sort of, occasionally boards will go off and get a valuation to underpin that, but there's no legal requirement to do so, and generally they won't spend the money to do that, and they don't need to. I don't think anyone's answered the question about, or I doubt anyone's, or many people have had to deal with the situation where where somebody exercises an option and the company has to advise the IRD what the value of the benefit was. There is the IRD guidance on it, which, as I say, I don't particularly like because it potentially leans towards too large a tax bill. I suspect that companies that do have option plans are going to have to, particularly companies that are more substantial and have quite a few options out there that are going to be being exercised, they're going to have to pay to get valuations done by an accounting firm for the purposes of IOD notifications, and those options will have, sorry, those valuations will have validity from the director's point of view for a period of time, and they'll have to renew and refresh them. There is some requirement around valuation of options under IFRS already. So if you're subject to IFRS, International Financial Reporting Standards, you've probably been grappling with some of that anyway, but for most startups, it's going to be a bit of a thorny one. And somebody else has asked, is there any implications for somebody giving up salary to be issued options? If the giving up of, if the options are still genuinely for incentivization and part of the overall, you know, then it's not an investment per se, it's part of their remuneration incentivization, that is fine. And there's no immediate tax implications for having an option. The implication is when you exercise it. And it's sort of implicit anyway that now employees, and particularly senior employees in tech startups, want equity, and they're effectively often sacrificing a higher salary they could get at another company in order to have access to that equity and options and upside. So I don't think there's anything inherently wrong with somebody or creating tax problems or FMCA problems with somebody saying, oh, well, I'm prepared to accept 100,000 rather than 120,000 if you give me this option package. It is quite hard to actually say how many options you should get in return for that trade-off, because it isn't sort of dollar for dollar. But I mean, I guess that's a perceptions of value sort of issue, and particularly younger people, developers and that sort of thing, tend to put a high value on cash, and people that are a bit older, you know, that have got a bit more access to cash or flexible mortgages, I suppose, or flexi loans, tend to put a bit more value on future capital gains. And Steve Whitaker's asked, just to be 100% clear, if we value the company at $1 million and offer the company 5% of the company in ESOP, do they only need to pay tax on this at the time of exercising? Yes, absolutely correct. There is no tax implication with options until the time of exercise. That is the beauty of it. There's no cash cost at all to employees until there is a reason to exercise your option, and that is that there's value in doing so. It's very clear cut, and it's, you know, it's no risk to the employees unless they want to exercise their options when there's no liquidity event around, and then they've got to make that difficult decision about paying tax. So unless there's any other questions that anyone, oh, here we go, another question. So Duncan asks, does the company pay any tax on exercise price, on tax exercise? No. So when an employee exercises an option, they have to pay tax on the gain. The employee actually gets a deduction. Sorry, the employer gets a deduction. So if the gain is 100,000 that the employee gets, they pay tax, let's say at 33 cents on the dollar on that. But the employer gets a $100,000 deduction. So in effect, the two net off. And that was I guess, something that the ID added in to the 1 April changes that didn't used to exist, and that makes the whole scheme fairer. And I think Casey, oh no, Bex has said, the ID released an officials paper in May discussing the taxation. Yeah, I think Bex, so that officials paper is the basis of the rules that are in place on 1 April. And there are a few ideas in there that I like, that I would have liked to have seen come into the law as it was implemented, and they didn't make it in. So there are ideas the ID had would have been helpful, but they didn't make it into the 1 April law. Having said that, I think the ID's point was that these are all things that could be addressed a different way. So the longer the exercise period of options, the more likely a an employee, that the obligation to pay tax will coincide with a liquidity event. From the IDs, one of the things was there wasn't many submissions from the startup sector's point of view. Most of the submissions that came in on the bill were from the big company end of town. All of the accountants were desperately trying to, and law firms were trying to maintain the old rort, really, that was going on, where you could issue shares on capital account with the economic benefits of options. And, I always thought that was a ridiculous thing to focus on, because that wasn't right and it wasn't going to survive. But because they were so worried about the big end of town, no one really, apart from our firm, was focusing on the effect of it for small companies. But I will give the IRD credit in that, they spent a lot of time talking with us about it. And they did actually engage us to do a piece of work as well, or to provide some formal feedback, which was kind of them. So, even though it was disappointing, there wasn't more voices advocating for the tech ecosystem. I think where the ID ended up actually is reasonably fair. So Joe asks, do you have to have an expiry on an option? No, you don't, but I don't think it's desirable, because things change, and if you're coming up to the things change, and generally speaking, it's best for any commercial arrangement, which an option is, to have an expiry date. But that's more of a commercial sort of philosophical point on my part. I don't see any legal reason or any tax reason that to mean you have to have an expiry date. One of the things about investors is that they don't like to invest in a company. There is an issue with investors, because investors will generally expect to see expiry dates on options and vesting schedules, that expect it to be done the normal way. And particularly for employees that have left the company, you want to have a point eventually where they have to either pony up and pay for some shares or go away if the company isn't going towards a liquidity event, and investors certainly have that point of view. So if you have a no expiry date, you're forced into a situation where if there's a problem and you want to make the option go away, you have to buy them out rather than just wait them out. And the ability to wait somebody out is kind of part of your negotiating position. If you've got no ability to wait somebody out, then you've got no negotiating position. It's sort of like granting a distribution arrangement or a distribution agreement or something like that with no expiry period. It just then means all you're doing is forcing yourself into a position where you have to negotiate with somebody with no cards. At least an expiry date, even if it's a long dated one, gives you some negotiating position. So if there's no other, one more question. Okay, so Steve's question, does a new valuation of the company, does this trigger any tax obligations for the ESOP chaps? No. So for a share scheme, once you've set the exercise price, there's no tax implications under a option scheme until you exercise the option. When you exercise the option, then you have to work out what the value is of the shares you're buying. If you've undertaken a capital raising round recently, then that will be relevant in working out what the value of the company is, and therefore the amount of the benefit or the amount of the gain the person has made. And from the IRD's perspective, they've got a paper on their website. It says that even though the VC may be getting super duper preference shares with lots of special rights, you can't, in working out the value of the benefit, you can't discount those shares by more than 25%, whereas in the States, there would be a 90% discount. But I mean, there's some of that to do with the reason New Zealand doesn't have a capital gains tax and the US does. So I think we'll make this last question. So Richard McLean's got a question. Related, I'll make this last one. Related to the need to show ESOP provisions in the cap table only, what is the rule that precludes an early stage company holding a percentage of its own stock for this purpose, or is that part of another talk? A company can't issue shares to itself under our Companies Act. And so that's the reason why. In the States, the shares are issued but held as treasury stock. You can't do that in New Zealand. You can issue the shares to somebody else and then buy them back and hold them as treasury stock. But the rules around holding treasury stock are really restrictive under the Companies Act. So it's just not worth doing, basically. And it works fine as it is. There would be no tax benefit or any other benefit for actually holding the stock. That's the way it, there's no difference. It just confuses people sometimes when you're talking about shares that haven't been issued. It confuses Americans a lot when they come to look at our system, but the stuff we do that's simpler than them. So overall, I think it works fine. So thanks everyone for tuning in. Thanks to Fiona for your help with the presentation, doing the slides and jumping into the talk. And we hope everyone found it valuable, and hopefully you'll tune in for our term sheet and equity investment seminar.